Welcome to Being Smart About Student Loans. This material is not intended to constitute any tax, investment, or legal advice. If you need legal, investment, tax advice, and/or credit counseling, please consult with a professional within those areas. Today, we're going to talk about understanding the differences between private education and federal student loans, monitoring your debt level, knowing the impact of your debt level on your credit history, and thinking about how much you can afford to borrow. Statistics tell us that if you haven't borrowed a student loan, you'll likely do it before you graduate. Student loans are generally considered good debt in that you will see a return on your investment. If you haven't borrowed a student loan, we hope you'll find some useful information in today's session on how to be wise and proactive in your future borrowing decisions. Federal student loans are from the U.S. Department of Education, and these include direct subsidized and unsubsidized loans and PLUS loans. To get a federal student loan, you go through your college. You're also required to complete the free application for federal student aid, also known as a FAFSA, before applying for the loan. To get the loan for the first time, you are required to complete entrance counseling and a master promissory note. Federal student loans often have low interest rates compared to private loans. Another important thing to keep in mind about federal student loans are the conditions and benefit, like alternative repayment plans, loan forgiveness programs like public service loan forgiveness and teacher loan forgiveness, and their interest rates. They're regulated by the U.S. Department of Education and are the same for every borrower. Your school determines the amount that you can borrow, and the amount cannot exceed your financial need. The federal subsidized loan is a loan through the Department of Education will pay the interest while you're in school at least half time, for the first 6 months after you leave or separate, also known as your grace period, and during periods of deferment. You must demonstrate a financial need for a subsidized loan, and there are maximum aggregate loan limits based on dependency. For the federal unsubsidized loan, they're available to undergraduate and graduate students. There is no requirement to demonstrate a financial need, and you are responsible for paying the interest on the unsubsidized loan during all periods of time. If you do not pay the interest while you're in school and during grace periods and during periods of deferment and forbearance, your interest will accrue and be capitalized. The PLUS parent loans are for parents of dependent undergraduate students. They are a credit-based loan. You'll want to follow your school's protocol for requesting a parent loan. If denied because of credit, then the dependent student can be awarded an additional unsubsidized loan. The Graduate PLUS loans, they're available for graduate and professional students, and they are credit-based loans. The student loan payment pause is extended until the U.S. Department of Education is permitted to implement the debt relief program or the litigation is resolved. Payments will restart 60 days later. If the debt relief program has not been implemented and the litigation has not been resolved by June 30th of 2023, payments will resume 60 days after that. The Department of Ed will notify borrowers before payment restarts. So how do you track your federal loans? Well, the best place to start tracking your federal loans are through studentaid.gov. This is the U.S. Department of Education's central database for student aid. Your school, the Federal Direct Loan Program, and the U.S. Department of Education submit information about your federal loans to this database. You can directly access the information on studentaid.gov. You'll use your FSA ID to log into the system, which is the same login information you use to complete your FAFSA. Once on your student aid dashboard, you'll find information about your federal student loans that you've borrowed, as well as your Pell Grant history. You can find out how much you've borrowed, the interest rate, and who your loan servicer is. Private education loans are different in that they come directly from lending institutions such as banks and credit unions. The interest rate for private student loans will depend on a variety of factors, including your credit history, and it could be a fixed or a variable rate loan. If you do not have much history with credit and repayment, you will likely need a cosigner for a private educational loan. Someone who will sign the application with you and promise to pay the loan back if you do not or cannot. You do not have to complete the FAFSA in order to get a private student loan, but you will need your school's financial aid office to approve it. Keep in mind, private educational loans conditions and benefits vary, including their repayment options, depending on the lender that makes the loan and the creditworthiness of the borrower. So, how do you track your private student loans? The best source of information for tracking and verifying your private education loans will be the lending institution from which you borrowed the money. If you don't remember which bank or credit union you borrowed the loan from, you should have a copy of the promissory note that you signed or possibly an email correspondent about the loan. Most lenders have an online system for tracking their loans, so when you take out your private education loan, make sure you ask your loan servicer about accessing your loan details online. If you don't have or you cannot find your promissory note for these loans, your college portal or the financial aid office may have information that can point you in the right direction. Finally, your credit report will help you verify details on any private education loans. Your loan will be listed on your credit report, including the name and contact number of the lender. Also, the loan amount. You can access this at annualcreditreport.com. So, why is it important to track your loans? If you don't track your student loans, there can be negative consequences such as not knowing who to contact when you need help, difficulty obtaining access to online information because you don't know the details of your loans, maybe missed payments, loan default, and adverse credit history. This is important because it's possible that you could be paying on a student loan bill every month only to find out that you've been missing another payment owed by a different type of student loan. You hadn't carefully tracked it. Your student loans are a part of your financial life, and it's very important that you keep up with them. And it's your responsibility to track them. In this section, we're going to talk about what a credit report is, what it tells us about our financial wellness, and how to get a copy of yours. How do my student loans affect credit? And what does it mean to have bad credit? Like bad grades, bad credit can greatly impact your current and future life. If you have a history of not repaying your debts on time and as agreed, lenders may be reluctant to give you credit in the future. You may also pay a higher interest rate because lenders will see you as a risky borrower. It's not just your future credit that's harmed. You could also have difficulty renting an apartment or getting a job or qualifying for insurance if you have bad credit. This is because a history of not paying your debts, employers and landlords may think you might also be a risky employee or renter. Your student loans are an opportunity to build good credit. You can get a copy of your credit report for free from each of the three um, credit reporting agencies once a year. The official site for this is annualcreditreport.com. You can ask for all three at once, which may be a good idea if you've never looked at your credit reports before, so that you can compare all three and make sure the information is consistent. After that, you can rotate through your credit reports and request one every 4 months. And that way you can monitor your credit throughout the year. During the COVID-19 pandemic, accessing your credit is important. So Equifax, TransUnion, and Experian are offering free weekly online credit reports. You do not have to pay for this, so be careful about websites and companies that ask for payments or sign you up for more frequent reports for a fee or offer to monitor your credit report for a fee. You may have heard of something called your credit score. This is based on your credit reports. Credit scores are determined by the private companies like Fair Isaac Company or FICO, or another one called Vantage Score, which is developed by the three credit reporting agencies. FICO and Vantage scores use formula to predict how likely you are to repay your debt, your credit worthiness. While getting copies of your credit report is free, you'll likely pay a fee to get your credit score, although many major credit cards are now offering free credit score monitoring. A positive credit history begins by taking control of your spending habits and thinking carefully about your wants and your needs. Your payment history is a crucial element in building good credit, and it doesn't just matter that you pay, you should pay on time. Your payment history is the most important factor in your credit score, making up to 35 to 40% of it. The importance of paying in time is not just true for student loans, but also for your car payments, your credit cards, and any other payments. Paying on time will build your credit history. What do you do if you just can't pay your bill right now? Well, not making a payment is the worst option. Contact your creditor and ask how they can help. Your creditors are interested in making sure that you can repay your debts and will generally work with you to ensure your repayment. They may be able to reduce your payment, extend your payment due date, reduce your interest rate if you're having difficulty repaying the debt. Take a look around and you may find stuff on your campus or in your community that will help you qualify for free or low cost medical care, or maybe a food bank, or even vouchers to help you with housing and childcare. While these things won't help you pay your bills, they can help you free up income to use in repaying your debts. And bringing it back around to federal student loans, pay close attention to the repayment options that are discussed during your exit counseling session that you will attend when you leave college. There are lots of repayment options that are there for you to help you manage your monthly payments. Next, we're going to talk about how much to borrow. So we always get the question, how much should I borrow? When you're thinking about borrowing your student loans each year, there are a couple important pieces of information that can help you make a good, informed decision about how much to borrow. First, think about how much you might earn when you graduate. Your income will vary depending on a number of factors, primarily your major and your level of experience, as well as your location. Keep in mind that some majors often have lower starting salaries than others. For instance, the starting salary of a teacher will be much less than of an engineer. You can find out salaries for various occupations by reviewing the U.S. Department of Labor's Occupational Outlook Handbook. Think about how much you've already borrowed and how much you may continue to borrow until you graduate. Use the loan simulator at studentaid.gov/loan-simulator. This is a tool that will help you make decisions about your student loans. You can manually enter in future loans that you plan to take out to estimate what payment will be and what repayment plans will fit into your needs. Now that you have these two pieces of information, think about how they're going to fit together. Will you be able to afford your monthly student loan payment on top of your housing costs, possibly a car payment and insurance and credit card payments, based on your expected income as someone who is just entering your field of employment? Some good rules to follow in keeping your spending on track are saving to buy something that you really want. Let's say it's the latest gaming system. It'll cost less than buying it with borrowed money. That's because when you save money, you earn interest, and when you borrow money, you pay interest. You can also use a 2-day waiting period for any unplanned expenses instead of putting it on your credit card right away. Waiting to spend might also give you time to figure out how much you really want that item and possibly avoid impulse buying. At the beginning of this session, we talked about student loans as a good debt versus a bad debt. Bad debt is something that costs us money. For an example, paying groceries for other consumables with a credit card. You'll pay a steep fee in the terms of interest for something that loses value very quickly. But good debt, such as a mortgage or a student loan, can actually increase your wealth because you generally see a return on investments through either rising home values or better career options. So borrow wisely if you need to, and think about student loans as an investment in yourself and in your future. Thank you for watching Being Smart About Student Loans.